The investment thesis is what we've trademarked the price step theory. And by that we mean that wines do not increase year on year in a linear fashion. They actually follow the whole demand and supply issue where the wine increases, or the value of the wine increases in a step function, which means that at a certain level, the wines are acquired at a certain price. And then once there's no more supply of wine at that particular price, then all of a sudden the wine might increase in value by 10, 20, 30% within a period of 2 to 3 months. And then there's a huge plateau again, and so therefore there's a massive supply at that particular price level, the increased price level, and then ultimately the supply at that particular price level is diminished or exhausted, and so therefore there will be a jump up in price again, which means that the wines will increase in value by, again, 20, 30%. And that increase is extremely fast, or occurs very quickly. And then depending on how much supply there is at that particular price, then the plateau could last for perhaps a year, could last for maybe 18 months until there's no more supply, or the supply is exhausted at that particular price. And then again, there'll be a step. So that's what we've determined as price step theory. And we chose Bordeaux for the reasons I mentioned before, but what the specifics of the wine fund, or the Wine Investment Fund Canada, are, which make it a very compelling investment, are multifold. First of all, the demand and supply, which I spoke to you about prior. And now, the other compelling arguments are the fact that there's no gearing or leverage at the investment level. That's not to say at the investor level you might borrow money to acquire your units in the fund, but there's no gearing whatsoever. So in other words, it's simply a situation where there's cash in, any cash that is acquired, we purchase the wines or invest in the wines, and then 5 years later we liquidate or sell off those wines and distribute the proceeds or the profits. So no gearing whatsoever. Then all the wines are held in bonded warehouse in London, and at a warehouse called London City Bond. And that is very important for for two reasons. One reason is that if it's held in bond, the buyer assumes the risk, caveat emptor from the legal term, which means that we buy in bond, we hold, and then we sell in bond. So we could sell wine that has actually been corked or gone off, but that is not our responsibility. It is the responsibility of the purchaser, the ultimate purchaser. And also the fact that we bought in bond means that there's no value added or VAT tax paid. So in other words, the investor does not have to pay the extra 17.5% or whatever the VAT is in England currently. The other reason that it's very important that the wine is held in bond is that for approximately $1 a bottle a year, a Canadian dollar a bottle a year, the wine is insured and stored, and it's insured for replacement value. So in other words, if the bonded warehouse burns down, or there is some sort of terrorism attack, or et cetera, and all the wine is destroyed, well, we are insured, or the asset class is insured at replacement value, which is a very, very compelling argument because, quite frankly, I cannot think of another asset class where there's no gearing, there's no risk assumed other than for the $1 a bottle a year, and there's a huge, huge, huge demand. So that's why we established the Wine Investment Fund Canada Limited, and we found that it's very compelling for investors for those reasons, and also, as I mentioned, because it smooths out any investment volatility curve.